If we don't have the right team, we won't make that investment. So it's got to be team, team, and team. And there's no I in team. Never try and take this journey alone. If you're building a tech company, I would always say to the entrepreneur, have at least two people. Someone that can build the stuff, the hacker. That's the engineer that can build. Mm-hmm. And then you need the hustler, someone that can sell the stuff. Because you can build and build and build and you can't sell. You don't have a business. So if you look 2-3 years ago, that capital was flowing into Africa big time. There was a lot of American investors, Asian investors, European investors that were putting money into South Africa and Africa. They've evaporated. They've disappeared. So even in America, the amount of capital in the later stages has dried up significantly.
Have they closed shop?
There are companies, honestly, there are companies sectors? Closing shop left, right, and center.
This episode of ITWeb TV is brought to you in association with ITWeb Security Summit, the must-attend gathering for IT security and business decision makers. Visit itweb.co.za for more information. Hello and welcome to ITWeb TV with me, Sibahle Malinga. Thank you so much for inviting us into your space for the next 30 minutes or so. Today we get up close and personal with renowned venture capitalist Clive Butkow, who has a remarkable career in helping to invest in and build multi-million businesses in Africa. And he, of course, has a wealth of experience in helping various organizations with their entrepreneurial development initiatives. He is the founder and former CEO of venture capital firm Kalon Venture Partners. And he's also the founder of South Africa's newest venture capital firm, that's a Conducive Capital, which has set a target to raise R1 billion in the next 24 months. Wow, that's a lot of money. Clive, welcome to the show. Thank you so much for joining us.
Thank you, Sibahle, and thanks for the opportunity.
It is an absolute honor to have you in our studios today. Well, Clive, you have a truly unique story to tell, and you've got many important business lessons to impart with us. Because coming up on the show this afternoon, we're going to be discussing some trends dominating South Africa's tech startup landscape. We're going to be exploring some opportunities as well as challenges that South African tech startups are grappling with. And we'll also be asking him the $1 million question. What exactly do venture capitalists look for, especially when evaluating a tech startup and its market potential? So that's all coming your way in just a moment.
I'm Nanjira Sambuli. I'm a tech policy researcher and one of the keynote speakers at the forthcoming ITWeb Security Summit. Catch me on 4th to 6th of June in Johannesburg, where I'll be exploring some fascinating topics like the role of cybersecurity in trustworthy African fintechs.
So, Clive, you and I briefly spoke at the end of last year when you were stepping down from your role as CEO of Kalon Venture Capital Firm. And, at that time, I think you may have raised more questions than answers. I, for one, thought, well, what could he be possibly planning? And I think the easiest thing to think, you've made quite a lot of accomplishments in your remarkable career. So I thought, well, he's probably, going to be moving to Perth and taking an early retirement and enjoy the rest of his life and live happily ever after. But of course, when the new venture capital firm launched this week, he took a lot of us by surprise. So tell us what the vision is behind Conducive Capital.
Yeah, thanks. So really, I was CEO, as you said, I was CEO and founder of Kalon Venture Partners. We had raised R250 million. It was under the auspices of SARS, had about 600 investors. And really the reason I moved on at the end of December was we had deployed the majority of our capital. We had invested in 12 companies. The companies are doing really well. As you said earlier, we've built some 100 million over, a couple of 100 million rand companies. And I really wanted to raise a further round of capital. I love this country. I don't love Perth. I don't want to go to Australia. I love South Africa. I think there's immense potential in our entrepreneurs. There's immense potential, and I believe it's an uncapped potential because there's not a lot of capital out there for these entrepreneurs, and particularly tech entrepreneurs, that they can achieve and reach for their dreams and surround themselves, get capital, surround themselves with mentors and other entrepreneurs. So I stepped back and I found during my sabbatical during November and December, I spoke to my co-founder, who's Mitch Adams, who's the ex-co-founder of Ozo, which is one of the top fintech payments companies in South Africa. And him and I shared the same vision. And the vision was really to get out there, raise R1 billion, help these entrepreneurs to achieve their vision and make their dreams come true. And I wasn't finished with it. Kalon was was a great opportunity to learn South Africa, a great opportunity to build a great brand. But it was time to move on and build something bigger. And so we've set ourselves on a very ambitious target, as you said, of raising R1 billion. But if we don't aim for the stars, we're not going to hit the moon. If we aim for the moon, we'll hit the ground. So we're aiming for the stars, and we either go big or we go home. And this country needs capital, and we want to be that solving that narrative that South Africa doesn't have enough capital. So that's why I'm here today.
Wow. Absolutely fascinating story that you have to tell. And, just going back to Kalon for a bit, I know that you actually helped build 12 companies and create quite a lot of jobs in the process as part of Kalon. And so, we've seen companies such as Ozo who are actually doing remarkably well. And that's thanks to funders such as yourself and others, of course. So how would you describe South Africa's tech landscape at the moment? I've heard venture capitalists talk about how some of the ventures that we're seeing, tech ventures particularly, are not as innovative and as disruptive as they would love. In fact, I wrote a story where I had, I think, about 5 VCs who all were kind of sharing the same narrative that as much as there is innovation, but when you compare it to the rest of Africa, where there's a lot of leapfrogging, it does leave a lot of room for improvement. So how would you describe the tech landscape at the moment in South Africa?
That's an interesting question, because I must say I am seeing some unbelievable innovation taking place in our country. We are, as I said before, we are a country of unbelievable minds, unbelievable talent. As the corporates retrench people, and as these people come out of corporates with highly skilled, they know banking, they know insurance, they know agriculture, they know education, whatever they might be. And what do? They turn into entrepreneurship. So just for the last 6 to 8 months, and since I left Kalon and started Conducive Capital, we are seeing 10 unbelievable entrepreneurs every single week.
Wow.
That really are redefining segments, they're redefining industries. But what they're short of, as I said before, and I don't want to sound like a broken record, they're short of capital, and they're short of mentors, and they're short of people that can actually help them see the road ahead. They have to stand on the shoulders of giants and don't make the same mistakes that other people have made. So as you said, I got intimately involved in those businesses. I've taken on a few more businesses now as well that I get intimately involved, and really helping these businesses see that pothole that they otherwise wouldn't see. And then someone say, well, how did you know that? They'll say, well, I've been involved in building about 100 tech companies, and I've seen it all before. I've got the grey matter, I've got the pattern recognition. They've got their blind spots, which I don't have all the answers, but I have quite a few of them. So I can help them see the road ahead and not go left, maybe go right. And right's to riches and left is to going over the cliff. So that's what I'm seeing in South Africa now. It's very, very encouraging, the innovation and entrepreneurship I'm seeing in South Africa.
But as encouraging and as optimistic as optimistic as you may sound, I was actually listening to Vusi Thembekwayo, who's also quite a successful businessman in his own right. He spoke about the fact that more than 50% of the businesses that he's invested in have actually not done well at all. And those are lost investments. He actually gave the figure, which was in the millions, that he had actually lost and sort of like thrown down the toilet. And so there is a risk it is a volatile industry, and there's a lot of risk in this business. So I guess that brings us into the next question. What exactly do venture capitalists look for in a tech startup in order to evaluate its market valuation?
So I think, let me just go back to your point you raised before I answer the question. I mean, it is definitely an asset class that is riskier than putting your money in the bank or putting your money into, the S&P 500. But the rewards are significant. So we look at returning a IRR, internal rate of return, of 30% to our investors. That's 30% cumulated every single year. Now, that is a substantial return. Yes, it's optimistic, but we think we can do it. We've done it before. But the risk is you could lose all the money. So that's the downside of that. And Vusi is right. It is a risky asset class. We fortunately didn't have that track record in Kalon. We had one blight in Kalon of the 12 companies we invested in. The others are really doing well. Just one. So, it's interesting. I learned quite a bit of my skills in Silicon Valley, and they're big baseball fans, as you would know. Not a big sport for us in South Africa. But the way they described it to me is a 2-6-2. So you'll get 2 home runs, you'll get 6, you'll go to base 1, base 2, or base 3, and you'll get 2 strikeouts. And the 2 home runs will basically pay for your fund and give you the 30% IRR. And so I've always used that metaphor of the 2-6-2 using baseball as an analogy. But, in all honesty, we're not here to lose 8 companies. We're here to maybe lose 1 company or maybe 2 at worst. We're here to make the balance of them actually work. And the key to me is about the involvement of the venture capitalists, because these entrepreneurs need not only financial capital, they need mentorship capital. They need people that have seen that road before. They need human capital. They need access to the best CFOs and product engineers and marketing and sales and finance. And we provide that as well. And they also need access to network. So that we provide them those connections, whether it's the connections to venture capital, whether it's connections to the trade, whether it's opening up a bank, whether it's opening up an insurance company. And we can do that in South Africa, we can do that in Africa, and we can do that all over the world. I spent 28 years at Accenture, and I have contacts all over the world to help these businesses in actually scale. So let me go to the second part of your question, which is really, what do we look for? So I call it the 5 T's. I've probably got 6 T's. So the 5 T's are number 1, team. If we don't have the right team, we won't make that investment. So it's got to be team, team, and team. And there's no I in team. I never try and take this journey alone. If you're building a tech company, I would always say to the entrepreneur, have at least 2 people. Someone that can build the stuff, the hacker. That's the engineer that can build. Mm-hmm. And then you need the hustler, someone that can sell the stuff. Because you can build and build and build and you can't sell. You don't have a business. You can sell, but you've got nothing to sell. You don't have a business either. So you need the hacker and the hustler. And the third person you need is someone that can really design the solution, which is the hipster. So they can understand the UI of the design and they can build out a brilliant, brilliant, brilliant product. So if you've got those 3 types of people in your business, that's what I look for in the team. Number 1, team. Number 2, I look for is the technology. I'm not investing in a Me Too technology. I'm not investing in a payments company that looks exactly the same as another payments company, or an education company that looks exactly the same as another 20 education companies. I look for a 10x times better. So the product must be 10 times better than anything else in the marketplace. So that's very, very important. So you really, the entrepreneurs need to know their competition. It's a critical part of their pitch to me is who are your competition, what's your value proposition, why are you better, how are you going to make sure you beat your competition. If they just say, well, we exactly the same as 9 other companies, it just becomes a race to zero. It becomes a price, it becomes a commodity, and basically just a race to zero on price, and you're not differentiated at all. So number 2 is that product. We want to see something 10 times better. We want to get a minimum 10 times return on our capital. So if we want to get a minimum 10 times... Are
you being realistic, though, when you say 10 times better? This is Africa, after all.
Absolutely. If I look at Ozo, they achieved, when they raised their last round, it was a 12 times return on capital. If I look at Senmark, one of my other companies, about a 10 to 11 times return on capital. If I look at Flow, which is another one of my companies, about 5 times return on capital. So if you look at our results, we were achieving a 30% IRR in my previous fund. We are achieving that I'm not saying in all the companies. We maybe not we're the 6 and not the 2. But we have achieved remarkable results. And the key thing there is your ability to pick the winners. So let me go back to criteria number 3. So the next one, the first one was team. The second one was the technology, the product. The third one is a large target addressable market. We don't want to invest in a market that's $1 million. So even if we get 50% of the market, we're a $500,000 company. That doesn't move the dial. We want to see there's a big market in South Africa, there's a big market in Africa, and there's a big market globally. So we want to invest in a very, very large target addressable market. Anything less than that, and we understand Uber as well. There's the Ubers of the world that thought they would just go to California and it was just taking away business from the taxi drivers, but it wasn't. It created a completely new industry for Uber. If you take Airbnb, it wasn't just replacing hotels. Every single person that had a room in their house or had a third, a second property suddenly became a customer and on the supply and demand side of Airbnb. So they've redefined their industries, and often entrepreneurs don't understand that day one, but we can see there's a big market, and then we'll look at investing in that market. Mm-hmm. Number 4 is traction. We don't invest in angel investing. We don't invest in seed investing. We want to invest in companies that have got some traction. We want to see the dogs eating the dog food. So we want to see that they've got some initial customers, they've got referenceable customers. I go and speak to the customers, or my team goes and speaks to the customers, and they are raving about the technology. I mean, the one question I asked during my due diligence, I say to the customer, if we took out your technology tomorrow, what would you do? If they say, well, all good, we don't really care, well, then I know we're not onto anything. We're not really solving a big problem. We want to make sure our entrepreneurs are solving a big problem, and no one is going to rip out their technology. We don't. If someone's going to rip out their technology and there's a very low cost of ripping it out, that's not an exciting technology for me. So traction is very important. They could have 100,000 Rand a month, they could have R1 million a month, but we want to see they've got some initial traction, and the traction is growing. We don't want to see that the clients are churning, and they every second month you actually lose the client because then you're not growing that big business. And the last of the T's is the tenacity. We want to see entrepreneurs that are tenacious. They're not going to give up. They have got conviction, they've got courage, and we want to see that in the entrepreneur. So if we just see they're the type of people that are just going to give up and walk away, I'm not going to invest in them. It's going to be hard. Starting a business is really, really, really tough. And if you don't think it's tough, you've probably never started a business. So that tenacity is absolutely critical, because they're going to get to times where they can't even make payroll. That biggest client of theirs churns and tells them they don't want to do business with them anymore. So someone described it to me in Silicon Valley. It's like going on a roller coaster in the dark backwards. And that's what it is. You don't actually know what's going to hit you next. You never, ever know.
I really, really inspire. I have a great deal of respect for entrepreneurs. I'm really inspired by them because they work extremely hard. And they have to do that over and over and over again, and sometimes for so many years before they actually get to get an ROI. And I know somebody who hasn't had a salary. That's what she tells me. She's an entrepreneur. She hasn't paid herself in 2 years. And I'm like, my goodness, how do you survive? So you're looking for businesses that are that have created a product that is 10 times better than what we're seeing in the African tech landscape. Have you already identified some of these businesses?
No, we have. I can't disclose them
Obviously,
at the moment,
yes.
But we've identified many.
Locally in South Africa?
South African businesses. We've identified some African businesses. We fortunately, both myself and Mitch are quite well known in the ecosystem.
Yes.
So a lot of people are turning to us with their fantastic ideas, and I mean, they are unbelievable. Our problem at the moment is we have not yet raised our R1 billion or first close of 300 million, which we're planning to do as Conducive Capital by July. So if we had raised that capital, I think we'd be in later stage discussions. We would have issued a term sheet, and we would be in the due diligence phase. But the fact we haven't raised the capital yet, which is what's undergo at the moment, we haven't been able to invest in those entrepreneurs. But it's unbelievable the talent and the technology that we're seeing at the moment, and they meet all 5 T's that I spoke about. So we are just really chomping at the bit to get our first bits of capital, get the first couple of 100 million in, that we can start taking advantage. And really not only taking advantage of for ourselves, but obviously for the entrepreneur.
Of course.
We are desperate for capital. There's not enough capital in the ecosystem here in South Africa.
And of course, funding has been drying up actually over the last 2 years.
Funding has taken a huge knock in the last couple of years. Since the heydays of 20 and 21, where their money was coming, people were making an investment and they were giving you the money, wiring the money the next day. They were paying 100 times multiples on revenue. So give you an example of that. If you're doing $1 million revenue, you were getting $100 million valuation. That's gone down now to 5 to 10. So if you're doing $1 million revenue, you might be getting a $5 to $10 million valuation. That's how it's all changed.
And what are some of the factors contributing to this? I have actually written a few articles. The most recently, a report that was conducted by Disrupt Africa, and they're saying that it all has to do with the economy being on a downturn at the moment, and then there's other factors in South Africa specifically where you find your load shedding and the big tech crunch. There's tech retrenchments that have been going on across the globe. What are the key factors that have contributed? Well,
I think you mentioned number one's the economy. The cost of capital in the heydays of 2021 was basically zero. So no one was putting the money in the bank. They was putting it into the local partners, as we would call it. They would invest in us as general partners, and they'd put a lot of money into other asset classes like venture capital. Since the cost of capital has gone up 6-7% and the market's gone down and the economy's gone down, a lot of that money has evaporated. It's gone away. So only the very, very, very best of companies are actually achieving capital. if you look at the venture capital space, you talk about a Series A, which is quite an early stage investment. A company's got product market fit, and you're really just putting more fuel in the fire to help them discover a repeatable and scalable and profitable sales model. But Series B and Series C is later stages where they're raising the much bigger amounts of capital, $10 million, $50 million, and that capital is basically dried up. So if you look 2-3 years ago, that capital was flowing into Africa big time. You know, there was a lot of American investors, Asian investors, European investors. They were putting money into South Africa and Africa. They've evaporated. They've disappeared. So even in America, the amount of capital in the later stages has dried up significantly.
Have they closed shop?
There are companies, honestly, there are companies closing shop left, right, and center. These are entrepreneur companies, and I know the tech sector. I'm sure there's companies right across the, all industries. But in the tech sector, we only hear about the big ones that are closing down. There are businesses closing down left, right, and center.
Every single day.
So no one is immune to this problem. But right now, things are starting to, I think there's a bit of an uptick. I think 2025 will be a much better year. I think still 2024 with valuations, there's a lot of downward pressure on valuations. A lot of entrepreneurs that raised that $50 million don't want to raise at $10 million because it's not good for their story. It's not good for the investors. But unfortunately, they have no choice. And a lot of the investors who they thought would just follow and give them more capital so they could keep on staying alive. And these investors have said, no, they're only backing their best ones. So what you do in the venture capital arena, you keep what you call dry powder. So you don't invest all your money. If we had $100 million, you only invest $50 million, and you keep the balance of $50 million for your real winners. So you can back their Series A, Series B, and Series C later on. So these entrepreneurs took it for granted that there would be another check coming down the line. Unfortunately, that has not happened. So unless, in some cases, the current investors have put another check in, but in most cases, those investors saying, the company's just not doing as well, the market, the economy, etc., and have stopped putting money in. And they haven't achieved cash flow break even. They're still reliant on the investor capital. The investors have closed the door. The business closes down. So unless there's a great saying made by Y Combinator, which is called either default alive or default investable. And what they did in the heydays of venture capital, no one cared about getting to cash flow break even. No one cared about getting to operating margin positive. They just cared about driving revenue. Just grow 20% every single month. Not every single year, every single month. And if you grow 10 to 20%, no one cared about capital efficiency. They never got to profit. But there was another check. So those entrepreneurs were incentivized just to grow the top line and not worry about the bottom line. But in the last year and a half, everyone's changed. Now, our Combinator are talking about becoming default alive. And what they're saying there is, stop chasing revenue at all costs and growth at all costs. Start becoming profitable. So if there is no more capital, at least you're cash flow positive. You can fund your growth out of your cash flow. So the whole world of investing has changed. There's so much less capital, and this is a good thing. This is a great thing for venture capital because you want to be a sustainable business, that you actually can stand on your own 2 feet and you can become cash flow break even. And that's what's happening. So we're seeing the great companies I've been seeing in the last few months have already achieved cash flow positive, but they want to raise the next round of capital to really drive that growth while they're keeping, as I said, default alive.
Wow. You're painting a really glim picture about really the consequences of startups not having enough capital or at least cash flow every now and again. And I suppose that explains what you and I were talking about off air, why we're seeing so many what we would have thought were successful startups in Africa close shop over the last year or so. And I was reading an article where 15 well-known startups, which, venture capitalists had said you have great potential, they closed up. And these are just the well-known startups, which means there's many more that we're not aware of that also closed shop last year alone across the continent. Which brings me to my next question. R1 billion in the next 24 months. That's no mean feat, especially especially with all the challenges that the sector is experiencing, and venture capitalists also obviously raising their standards. How do you aim on attaining this? Are you focusing on local funds, international funds?
So I think, go to your first point, we are ambitious. Mitch and I are ambitious
people.
Super
ambitious.
We are ambitious, but if we didn't think it was doable, we wouldn't be doing it. There's one thing about being optimistic and about being stubborn. I don't think we're being stubborn. I think we're being optimistic. And we believe there is capital out there. There is capital for the best companies. And Mitch and I have got a fantastic track record. We've built companies, we've invested over 300 million rand, we've had an internal rate of return of over 30%. Mitch exited most of his shares out of Ozo. He made a nice little return on his investment. So we are optimistic. We think that we've had quite a few very, very encouraging discussions. You were at our launch earlier this week.
Yes.
A lot of those investors came to us and said they really want to find a way of investing. So there's a lot of interest in the fund. Funding doesn't happen overnight. It's a long road. If you're a cricket fan, it's not a 5-day game. It's not a 2020. It's a 5-day game. It's a long haul. So we're saying by July we'll have our first 300 million. We're hoping that with the conversations that are underway at the moment, and then raise the balance of 1.7 billion over the next 18 months after that. And that will be definitely more overseas capital, where you can invest in dollars, pounds, euros, or whatever currency it might be. Mitch and I have started having conversations with some overseas capital, and a lot of them are actually looking for Africa. You get two types of venture capitalists overseas. They're totally neurotic about Africa, and they don't want to go near Africa. They won't touch it. And the others are saying, wow, Africa's the next frontier. It's the next growth opportunity. There's 1.2 billion people in Africa. There's 500 million people that are called the missing middle, what McKinsey calls the missing middle, that have got that income to take out insurance, take out payments, take out education. And by 2050, they say there'll be a 2+ billion population in Africa, which will be, or even more than that, which will be a significant portion of the global population. So Africa, I believe, is the next frontier. I believe right now, with the lack of capital, it's a great opportunity for us. The valuations in Africa have come down significantly. So again, a great opportunity for us to start a venture capital company, where 2 years ago we would have had to pay $100 million. We get the same company now for $10 million. So the cost of getting us in there now is substantially lower. And one of the key questions I always ask my entrepreneurs, I say, why now? Why are you doing this now? Why is it going to make a difference now? And our why now, Conducive Capital's why now, is exactly what I've just said now. There's a lack of capital in Africa. The valuations have come down. There's unbelievable human capital. There's been retrenchments left, right, and center. Retrenchments from entrepreneurial companies, retrenchment of engineers, retrenchment from the corporates. So we have access to unbelievable talent. And it's all about that incredible talent that we have in South Africa and Africa. And we have access to that. So that's what you need to build a great company. As I was saying, number one earlier was the team. So if you look at all the stars, I believe they're aligning for us right now. And now is the best time, I think, in my career ever, of raising a venture capital company. Will it be easy? No. But if it was easy, everyone would be doing it, and I wouldn't be doing it because it's too easy. We like a challenge, and we will go big or go home. But we're going to go big, and we're optimistic we're going to raise the billion.
Wow, amazing. So it's pretty clear what Conducive Capital has to gain and your vision and how that's going to trickle down to the startups that you fund. But what's your value proposition to your prospective funds?
Now, that's a great question. I mean, I think if we look at South African venture capital, South African venture capital is still a cottage industry. It's made up of maybe in the tech sector, 10, 15, 20 maybe venture capital companies. It's very, very, very early stage. If you look at the US, you've got thousands of these venture capital companies. There's just billions and billions and billions of dollars. South Africa, we're not in that situation. And if you look at and no disrespect to my peers in venture capital, but if you look at most of them, their backgrounds are accounting. They're chartered accountants. They're from the private equity background, much later stage. They're actuaries. They're lawyers, but they're not entrepreneurs. They haven't built tech companies. Now, if you look at Mitch and I, we are entrepreneurs. We have built so many and have been involved for so many years of building tech companies. As I said, I've been involved in building, exiting, and helping build about 100 tech companies. We are the entrepreneurs behind the entrepreneurs. We have built the $0 to $1 million company. We have built the $1 to $10 million company. We have built the $10 to $100 million company and the $100 million company above. And most of our peers, in all honesty and no disrespect, they have not done that in the tech world. So they're not sure exactly what is it you need to look for. How do you help these entrepreneurs? What are the metrics you need to look for? How do you make sure you don't get to default dead, which is what I was talking about earlier? And Mitch and I, we believe there's very, very few entrepreneurs or venture capital companies in South Africa that actually are entrepreneurs working behind the entrepreneurs. So we are the operators. We operate, we get involved in our companies, we work with them daily, if not weekly, we work with them daily, and we help them see the road ahead. We know what they're going through, and our success rate, hence, has been far greater than probably what it is globally. And we feel very, very optimistic and bullish about what we can do as the two of us, and then our team we will hire in Conducive Capital.
Wow, I can almost see it happening, as you paint the picture.
Yeah.
So in my conversation with Mitch, he actually spoke about, several objectives, but one I'm particularly interested in, perhaps let me say two, is you're in the long term hoping to also build unicorns. And you mentioned how in South Africa, you'd like to start seeing unicorns within the first 5 to 10 years, or should I say the next 5 to 10 years. And another thing that came out tops was your passion around job creation in South Africa through the startups that you'll be funding. Let's talk about unicorns. Why is it that we don't see any unicorns in South Africa? I know there's a couple in Africa, but why does South Africa have no unicorns?
I think watch the space. I think it's a matter of time. I think with the innovation that we're seeing with some of the companies we invested in, Kalon, I think we're going to see those unicorns. If I look at some of our competitors, some of the companies they've invested in, I think it's just a matter of time. Within the next 5 to 10 years, we will start seeing those unicorns. If you look at America in the last year, there's hardly been any minted unicorns because it's just so hard. Before, if you got to a $100 million company, you would be a unicorn, which is $1 billion company. And I believe in Africa, South Africa, we will start seeing those unicorns. But we need capital. That's what probably, I think, the biggest impediment of us growing unicorns is not having sufficient capital that we can invest in the earlier stages and then invest in the later stages, the Series B and the Series C, where we can inject that capital, help them scale to Africa, help them scale globally. But I'm very bullish what we're going to start seeing in South Africa. And it is going to take 5 to 10 years. This, again, is not tomorrow we're going to wake up with a couple of unicorns. Mm-hmm. It's going to take 5 to 10 years, but I'm seeing that innovation, creating new market segments, creating new industries. Watch the space. And of course, the ripple effect is job creation. A typical unicorn, how many jobs would it create? Well, hundreds and hundreds of jobs, if it's not thousands. So if I just look at the Kalon portfolio, we created hundreds and hundreds and hundreds of jobs. And that, if you think about it in South Africa, that feeds thousands and thousands and thousands of people. So one of our clear mandates in Conducive Capital is we have that social impact part of what we want to do. We want to hire many, many, many people. We want to, in fact, one of the mandates, and I think what got Mitch excited about what I wanted to do, I want to help train the next level of black venture capital females in South Africa. We don't have enough women in venture capital. We definitely don't have enough black women in venture capital. And even the few venture capital firms that we had seen over the last few years have closed down. Uprise Africa, and then there was another female venture capital firm that was purely focused on females. Honestly, we want to change that. We want to win. We've got a commitment from one of the SASME fund, and it's not a hard commitment, but they will pay, which is an amazing, and I take my hat off to what they're trying to achieve. They will help us hire the black female next level of venture capitalists, and they will pay, say, 80% of their salary. We would pay 20% of their salary for the first 2 years, and we will really help mentoring them, which will be actual mentoring. It will be all types of exposing these young black women to what it's like to build a venture capital company. And I'm optimistic in 5 years we'll be producing in ourselves 10 to 20 black women that can actually start their own venture capital companies, which is exactly what South Africa needs. We are desperate for that, but it's not going to happen overnight again. It's going to take a company like ourselves who are tech entrepreneurs, who understand venture capital, got many years of venture capital experience, that will invest in these young black women and create that next level of venture capitalists. Well, hopefully that's going to play an important role in changing the status quo in South Africa, because we write about, how we're just not seeing enough women entering the tech companies, the tech field on a daily basis. And the numbers are really shockingly low, whether it's cybersecurity or in the engineering. We're not seeing near enough. And out of the few that do enter the field, many of them end up resigning because of a host of other challenges that they're subjected to. So it's really encouraging to hear that you have a huge focus in gender representation. So let's talk about what is your biggest priority right now going forward? You've launched this week, and where to now? Raising capital, and raising capital. So I suppose that's endless meetings for you. Kissing as many frogs as we can, because we know there's a couple of princesses at the end there. So maybe we have to kiss 100 frogs and we'll get one princess coming up. But that's okay. That can raise us the $30 million to get our first fund closed. But yes, it really is. It's networking. We've got great networks. It's about seeing as many people as possible, sharing our vision with these people, making them buy into our vision, and investing in us. And seeing they will get a great return on their capital. So the real focus for the next till July really is about raising capital. If we can do it earlier, we'll obviously start deploying that capital. But raising capital is not it's not a destination, it's a journey. We'll keep on raising that capital, but at least we can start deploying that capital into these great entrepreneurs that I was talking about earlier.
Speaking of entrepreneurs, we actually have quite a lot of entrepreneurs that watch our show and that read our articles on ITWeb. So, it would be great to pick your brain on some of the biggest mistakes that entrepreneurs make, especially from a local context.
I think, there's many. I'll be honest with you, there's many. And I see them every day because I get pitched we see about 100 pitches a month. What I try to explain to entrepreneurs, not every business is a venture capital investable business. It doesn't make it a bad business. It's just not a venture capital investable business. And what I mean by that is I won't see a 10x, 100x return on my capital. They might have a great business. It might be a great family business. Maybe it's a business they want to hand over to their family, but it doesn't mean it's a venture capital investable business. Why we like tech is a lot of them are very scalable. You can scale them into Africa. You can scale them globally. A lot of small businesses, they are not that type of business, but they are great businesses, but they're just not venture capital investable businesses. So a lot of entrepreneurs get very offended, but they shouldn't be. There's nothing wrong. There's no right and wrong of what type of business you want to grow. Not everyone's going to become a NOSA, a CarScan, a Senmark, a Flow. Not everyone's going to become.
And that doesn't mean they will not make profits.
Absolutely. They could build a great business for themselves. They can feed their family. It's fantastic to see that, and we need more and more of those entrepreneurs out there. But that doesn't mean they're venture capital investable businesses. And as I said, there's no right and wrong of what type of business that you grow. Just keep on. The message I give to every entrepreneur, don't give up. And the next lesson that I find is they don't understand their unit economics. They don't understand their accounting. They expect, when I ask them, so what's your revenue forecast? How much cash have you got left in the bank? When are you going to go? Your money's going to run out. And they say, well, my accountant's not here with me. What they need to understand is every entrepreneur doesn't have to be an accountant, but they need to know their numbers. Warren Buffett says accounting is the language of business, and he's spot on. Accounting is the language of business. And I will not invest in an entrepreneur that cannot understand what an income statement is and what a balance sheet is and what a cash flow statement is. At least know those are the three key statements from a financial point of view that I'm going to look at. But I'm going to look at that income statement. I'm going to look at their gross margins. I'm going to look at their operating margins. If you're making a 10% gross margin, I'm not interested. If it's a tech business, the beauty about a tech business, you can be making a 70, 80, 90% gross margin, that there's enough money left out there for marketing, for sales, before it actually hits your operating margin line and you get to negative cash flow. So know your numbers. And it's such an important thing that, honestly, probably my biggest bugbear is entrepreneurs don't know their numbers. Mm-hmm. They need to understand where their business is going from a financial point of view.
I suppose that's why we need more accelerators and boot camps. And you yourself have said in our previous conversations that we're just not seeing enough mentors, particularly in the tech space, to guide these entrepreneurs, because no matter how good you are, there's always room for improvement and there is an area where you might need to learn. So how important are these accelerators and just having an entrepreneur who has the experience walk the journey with you?
I think having an entrepreneur work the journey with you is the most important thing. If accelerators have got those types of people, they're great. But a lot of accelerators that I've been exposed to don't have those type of people. They're more corporate type people. They haven't built businesses before. They haven't seen the road ahead. So if you look at like a business in Silicon Valley, Y Combinator, which is probably the most prolific accelerator in the world, they have ex-entrepreneurs who are their mentors. That's who teaches these businesses which way to go. Don't go left, go right. In South Africa and Africa, there are some of those, but there are lots of them that aren't that. And those accelerators they're not worth the value that they talk
about.
Those
accelerators are actually pumping a lot of money and channeling it into these businesses. Are you telling me that there is not enough talent and skills development that actually goes into that?
I would say that talent is far more important than money. Money is the least important thing, because a bad business with or without money is a bad business. It's not going to make it a good business. A good business without money will still be a good business, because if they go through an accelerator and they've got the right type of mentors, the right type of advocates, be an apprentice. They must apprentice under these people. But most importantly for entrepreneurs, maybe it's another lesson, be coachable. Listen to people that are ahead of you on the journey. If they've got 40 years experience and you're 22, you don't have all the answers. I don't expect you to have all the answers. You have to know what you don't know. And it's okay to know what you don't know. It's a sign of good leadership to ask for help. That's not a sign of weakness. That's a sign of strength. And I see too many of these entrepreneurs that believe they have to have all the answers. And they try and come up with all the answers. And you see a slow motion crash going over a cliff when they just won't listen to other people. They surround themselves with clever people, but then they don't want to listen to them. Now, you have to be coachable as an entrepreneur. Well, you're not getting my money if you're not coachable.
So be honest with yourself, and be aware of what you still need to learn, and that's the only way of learning.
I think your point about being just be self-aware. Be self-aware. Self-actualization. You don't have to. You're 22. You don't have all the answers yet. You don't have to be the goalkeeper and the striker and the defender and the midfielder and the ref and the VAR and the coach. You can be one. You can be really good at sales and marketing. But get help on product, get help on finance, get help in the other areas that you don't have to know. Play to your strengths and surround yourself with people that play to your weaknesses. You don't have to be good at everything. You're not going to be. I'm not, you're not, none of us are. But you have to be self-aware to know what are your strengths and what are your weaknesses.
I was interviewing some of the members of the Startup movement, the Startup Act movement, and they was talking about how in so many instances, and even some of the challenges that you've alluded to here, regulation can sometimes be a red tape, and it can hinder startups from innovation, from accelerating and further growth and scaling. Can you just talk to me about, how much of a hindrance startup regulation can be to startup growth?
I think, startups are great. I think that from a government point of view, I think there's definitely a lot of initiatives, as you said, these startup initiatives that they're trying to take heed of. I mean, Section 12J, which was where I came from in Kalon.
Which closed down.
Which closed down, unfortunately, which was a real pity. I think it was being abused by a number of players. And I think the bad players, the rotten eggs, destroyed the good eggs, and they closed it down. So that was really unfortunate from an entrepreneurship point of view. But in all honesty, I think the government is trying to do things, but it's still not easy. If you want to take your intellectual property to a place like Delaware, where you can raise capital in American dollars, you can exit your business in American dollars, it's hard to get your intellectual property offshore. So I think there could be as everyone calls it, from red tape to red carpet. We need to get to that red carpet. We need to make it easier for entrepreneurs to grow their businesses, scale their businesses, and take their businesses, if they need to, take them offshore. I love taking a business that's got all their headcount and all the hiring takes place in South Africa, and the costs are all in rands and the revenues are all in dollars. It's a phenomenal business when you've got that rand edge, you've got dollar-based revenue, and you've got rand-based costs. But if you don't let them go to America, you're not going to get that dollar-based revenue. So I think the government's moving, but I think they could move a lot faster. And I really do believe if we could have immigration laws like they have in America, we could bring entrepreneurs out to start businesses. A very interesting statistic that I read the other day of the NASDAQ top 500 tech companies, something like 50% are foreigners. They're immigrants. The CEO founders are immigrants. And they are hiring hundreds and thousands of people. So we need a startup act that actually brings immigrants into this country. Great to start up a company. Great at hiring a company. Great at increasing the GDP and the fiscus. So there's nothing wrong with that. And we need to be more open and conducive, excuse the pun, but conducive to these entrepreneurs starting in South Africa.
Especially in light of the Africa Free Trade Agreement that that has just made its way to the continent. So, Clive, I've just heard something that you spent some time in Silicon Valley now. Just heard you say that now, and I think it's worth finding out. What have been some of the lessons to you, just as a parting shot before we wrap?
I was very young in my career when I did spend time. I spent time in London, I spent time in Silicon Valley, and then I worked with startups, and it was fantastic. I think I learned most of my skills. I learned incredible skills there, and I learned from mentors. I surrounded myself with people that had done this for 20, 30 years, and they were unbelievable. And unfortunately, I was self-aware enough to know that I knew nothing. I really knew nothing. And I learned from them. And I brought those lessons home, and, you keep on learning. But I think life is a learning journey. And I think the most important lesson about wherever you work in an entrepreneurial ecosystem or any ecosystem, just be open to learning. Be open to understand that you are a work in process. You're not the finished article. You are a work in process. So understand your work in process. Understand you're not the finished article. Leadership is about learning, and learning is about leadership. Just keep on learning. And if you're open to learning, who knows what you can achieve. You can achieve unbelievable stuff. I still try and read every night of my life. I try and read. Wow. Every week of my life, I try and read a book. I don't achieve that always. When I'm on holiday this December, I read about 8 books. So I just want to learn, because I only do nonfiction. I don't do the fiction stuff, because I love learning from other people. I listen to podcasts, YouTube. There's no excuses not to learn.
Absolutely, especially not in the digital age.
Not in today's age.
It's just a touch of a button.
A touch, and mostly for free. So there's no excuse not to know.
Wow. So there you go, continuous learning, and I think that's great advice. Well, there you have it. Thank you so much, Mr. Clive Butkow, who is, of course, a renowned venture capitalist. He's the founder and former CEO of venture capital firm Kalon Venture Partners. And he is also the founder of South Africa's newest VC firm, Conducive Capital. And of course, do remember to subscribe to the ITWeb TV channel here on YouTube. And this episode has been brought to you by ITWeb's Security Summit. This episode of ITWeb TV is brought to you in association with ITWeb Security Summit, the must-attend gathering for IT security and business decision makers. Visit itweb.co.za for more information.